One summer moment can change a child's life. Through Toys for Tots Give and Go initiative, your support provides books, games, toys, and outdoor adventures that spark curiosity, creativity, and a love of nature. Whether it's fishing, learning a new sport, reading under a tree, or playing with friends, these moments build confidence and lifelong memories. For too many children, those moments never come. You can help change that this summer. Visit toysfortots.org. Toys for Tots, delivering hope beyond the holidays.
Listen, all you New Yorkers. Excuse me. Taxi.
Okay, man, we're looking around.
This is the 77 WABC minicast.
Good morning. This is Mike Stoller for the Stoller Real Estate Report. It looks like there's a lot of money out there for real estate. There's a lot of real estate activities taking up place, but there's a substantial amount of money from a variety of sources for financing. So I'm lucky today to have this 33-year-old guy who's been in the business for 12 years. I have Matt Swerdlow, who is a senior director at Ariel Property Advisors. Thanks for being here.
Super excited to be here.
So let's talk about how you got into the financing of real estate first.
Awesome. So if we want to go back in time, I graduated Lehigh University with a real estate finance degree, generally pretty social guy, and found myself into brokerage. The question was, what vertical? Leasing, investment sales, finance ended up being my calling. I love the aspect of marrying borrowers to lenders. Many folks think that you can walk into a bank and get pretty decent terms, but when you see the world from my point of view and you realize how many mortgages, all the different shapes, sizes, colors that they may come in, you realize that it really behooves you to be a specialist of the space.
Let's talk a little bit about banks who have left the marketplace. That's happened over the years, you know, the situation of Signature, First Republic, and so on.
Super interesting topic. Since about 2015, we've lost, I'd probably say about 10 to 20 depository relationship banks in New York City. These are stalwart incumbent participants, especially in the New York City multifamily lending space. They've either been merged, acquired, or they don't exist anymore for other reasons. And that consolidation has not been replaced. I think in the last couple of years, there's only been 3 de novo bank charters issued to New York State, which has not replaced the amount of banks that we've lost. So it's a really interesting dynamic to see this imbalance of debt capital that borrowers are now having to wade through, especially as their collateral is certainly looking different through the regulations that have hit us since 2019.
Let's talk about alternative financing. That's an interesting topic.
Yeah, so we're really pioneering a new topic called private credit, right? You hear about it in the news, the Blue Owls of the world. These are essentially private equity debt funds that are raising non-recourse, they're raising funds to issue fixed-rate, non-recourse term loans. They're sized on in-place cash flow, but their parameters are way more aggressive than the bank underwriting right now. So in one extreme, we have one debt fund, private credit fund, that is advertising 80% loan to value, subject to a 1.0 interest-only DSCR for loans above $15 million. They were in our office looking for national business. We said, have you guys looked into rent-stabilized multifamily? They said, let's go back to the office and ask about it. They called me again 9 a.m. tomorrow, the next morning, and said, if you have stuff of scale, we'll absolutely consider rent-stabilized housing, which is an interesting entrance to the market where a lot of banks have retreated specifically from rent-stabilized lending due to the legacy balance sheet issues that they have from HSTPA, COVID, collections, and now interest rates.
So what about the insurance companies? Have they become active again?
The insurance companies definitely have a ton of debt capital to issue, but they are looking nationally. They want to be in gateway markets, trophy assets, and they generally want to be around sub 60% loan to value with a strong DSCR and going in debt yield. Because of the nature of rent-stabilized housing, it's not really something that is really in vogue with the life co-lenders. But if you have a free market trophy elevator building, you're going to see a lot of appetite from the life insurance companies at some very aggressive spreads. We're looking 100 to 150 over for some long-term money.
Okay. With regard to loans on portfolio, and banks buying paper,
Are banks buying paper?
Yes.
I would say they're probably net sellers of paper. We just saw the closing of Ocean First and Flushing, which closed on June 2nd. Part of that sale or merger, not really sure the dynamic, was a sale of a $1 billion pool of legacy Flushing Bank loans that clearly Ocean First just did not want as part of the acquisition. So that I would say banks are generally looking to relieve their balance sheet.
Which banks are aggressive today in doing loans?
There's really one name. There's one elephant in the room. It's Chase Bank. Chase Bank's CTL multifamily lending platform is hyperactive. I believe nationally they're looking to put out about $5 billion of loans. And they
also do it with no fees, correct?
So where the 4 for Free program is very unique. They do no origination fees. They pay for lender legal. They pay for the appraisal, the phase 1, and if you use their affiliated title insurance company, they'll pay for the lender's title premium as well. On a small balance loan, they're doing loans between about $1 to $25 million. That can be a really dramatic savings on a small balance loan for any one borrower, which they use to their advantage. In addition to just being a very strong platform, we've been told they're very borrower friendly from our clients.
What about finance companies?
What do you mean?
I mean that, when you're financing somebody's notes, people are buying your notes.
So note-on-note financing?
Yes, note-on-note financing.
Note-on-note financing, also very popular. Banks are trying to figure out how to get exposure to commercial real estate without booking those loans directly on their balance sheet because the regulators want them to weight that risk with a certain amount of deposits. So they're asking themselves, how do we get this exposure without the risk weighting? The answer is note-on-note financing, not a direct loan against real estate, but they're also investing into funds that are issuing loans themselves, which is really where that private credit concept is coming into vogue because the banks are pumping money into these funds to make underlying loans against real estate, but to the regulator, that's not a direct loan against the collateral.
What about Fannie and Freddie?
Fannie and Freddie have a lot of money to put out this year. They have to put out $88 billion each. We're just outside of the first quarter. We're seeing that Freddie Mac is on track to hit those caps. Fannie Mae is behind the ball. What we generally see when there is a lot of allocation to put out in a short amount of time, we start to see specials similar to Costco or Walmart. Many times those can look very different. For example, they have raised the LTV constraint on full-term interest-only loans for 7 and 10-year money. So historically, it's been 65% loan to value subject to a 125 DSCR. They raised it to 70 to try and compel borrowers to come their direction. But I would say Fannie and Freddie need acquisitions to pick up nationally for them to hit those caps. That's a very interesting part of the market for them to for them to be as aggressive as they are. And from our borrowers, we're really seeing that Fannie and Freddie are getting very cumbersome with their servicing requirements. Not just financial reporting, but ongoing maintenance of their collateral. Fannie or Freddie will tell a borrower, we're going to show up on this date, please give us a tour of the property, and they'll itemize immediate repairs mid-loan term that have to get cured. That surprise CapEx is something that borrowers are not really underwriting in their pro formas, and yet it is a consequence of getting government-sponsored debt today.
What about construction financing?
Construction financing is definitely in vogue right now. Permits across New York City are growing. These are condo projects and affordable projects with
less than 99 units?
Correct, through the 45X program. It is working, which is nice to see. There are shovels going in the ground, and the banks have definitely entered the space with a significant amount of lending capacity. And the non-banks are actually, it's a different flavor of loan, but we see many borrowers go that direction due to the intangible benefits that you get by going to a non-bank, such as non-recourse guarantees, quicker draws, quicker closing, no depository relationships. All these things, they're non-economic, but they still matter to clients. And so there's no wrong answer. The banks are in the market. The non-banks are in the market.
Who are the new players?
In the construction lending space?
In general. in the real estate financing space in
You
New
know
York.
what was an interesting entrant that we saw last year? This is a large depository institution. U.S. Bank has entered the New York City multifamily lending space, trying to mirror Chase's platform with $1 to $20 million. They're typically Chase's biggest competitor on the West Coast, from what I understand, and they're trying to enter New York City, or they are. They're actually I believe the numbers just came out recently. They should be a top 10 lender in New York City for the month of April or May, which is an interesting feat, right? So that entrance is very well welcomed, since we are not creating new banks. And I would say for any bank listening, there is market share to be had in New York City.
There are always some banks listening, and I think they've gained a lot of insight from hearing from you. And thanks for being here today.
Anytime.